Hello, friends. If you were born before 1961, there is a specific and urgent reason why this video matters to you more than it matters to anyone else watching it right now. The rules that govern your Social Security benefit, the full retirement age that applies to you, the delayed retirement credit calculation, and the specific legal changes that took effect in 2025 all combine to create a window for people in your birth year range that does not exist for people born later. The number I want to focus on today is $26,544. That is the annual difference between the lowest possible Social Security benefit available to a maximum earner and the highest. $2,969 per month if you claimed at 62 versus $5,181 per month if you delayed to 70. Multiply the difference by 12 and you get $26,544 per year, permanently, every year for the rest of your life, and for your surviving spouse, every year for the rest of their life after you are gone. My name is Carter Hale. I'm an enrolled agent licensed by the IRS, and I've spent 15 years helping seniors navigate the intersection of tax strategy and Social Security planning. The 5 issues I'm going to walk through today are the ones that matter most specifically for people born before 1961, and that most people in your birth cohort have never been fully informed about. Let me start with what makes people born before 1961 different from those born after. For people born between 1955 and 1959, the full retirement age ranges from 66 years and 2 months to 66 years and 10 months. For people born in 1960 or later, the full retirement age is 67. This distinction matters because every year you delay past your full retirement age, up to age 70, adds 8% permanently to your benefit. For someone born in 1958 with a full retirement age of 66 and 8 months, delaying from that full retirement age to 70 adds approximately 26.7% to their benefit. For someone born in 1955 with a full retirement age of 66 and 2 months, delaying to 70 adds approximately 30.7%. These percentages translate directly into real dollars. A full retirement age benefit of $2,800 per month becomes $3,661 per month at age 70 for someone born in 1958. The difference is $861 per month, $10,332 per year, permanently. The first major issue I want to address is the Social Security Fairness Act, because this is the change that has the most immediate and significant financial impact for people born before 1961 who worked in public service. On January 5, 2025, the Social Security Fairness Act was signed into law. It permanently eliminated the windfall elimination provision and the government pension offset, 2 rules that had been reducing or eliminating Social Security benefits for people who received pensions from jobs that did not pay into Social Security. Teachers, firefighters, police officers, federal employees under the Civil Service Retirement System, and many state and local government workers were affected. For people born before 1961, who are now in their mid-60s or older, this law arrived after many had already been receiving reduced benefits for years. The Social Security Administration was required to recalculate every affected beneficiary's payment and pay the difference retroactively to January 2024. By mid-2025, over $17 billion had been distributed to more than 3 million people. But here's the situation I want to address specifically. If you received a pension from a non-Social Security covered job, and you never applied for a Social Security spousal or survivor benefit because the government pension offset would have reduced it to 0, you may have an unclaimed benefit right now that you have never received. The elimination of the offset means what was 0 is potentially hundreds of dollars per month. But the SSA does not automatically start paying you a benefit you never claimed. You have to apply. If you are a widow or widower of someone who worked in public service with a government pension and you never filed for a survivor benefit because you were told the offset would eliminate it, call the Social Security Administration at 1-800-772-1213 immediately and ask specifically about your eligibility under the Social Security Fairness Act. The retroactivity is limited, meaning every month you delay is a month of benefits you may not be able to recover. That is the first major issue. The second major issue is the 0-year problem in the earnings record. And for people born before 1961, this takes a specific form worth addressing directly. Social Security calculates your benefit using your 35 highest earning years. For someone with fewer than 35 years of work history, zeros fill in the gaps. Each 0 year reduces the 35-year average and permanently reduces the benefit. For people born before 1961, who are now in their mid-60s, the opportunity to eliminate 0 years by working additional years may still be available. For someone who is 63 or 64 and is not yet claimed, working 1 or 2 more years replaces 0 years in the calculation with current earnings and permanently raises the base benefit. Log into your My Social Security account at SSA.gov and review your earnings record year by year. Count the years that show actual earnings versus years that show nothing. If you have gaps, model the benefit at different retirement ages using the SSA estimator. The improvement from 1 additional year of work replacing a 0 can be $40 to $120 per month permanently. The third major issue is the delayed claiming calculation, and this is where the largest portion of the $26,000 figure comes from. Your full retirement age, depending on your specific birth month, ranges from 66 years and 2 months for those born in 1955 to 66 years and 10 months for those born in 1959. For every month you delay past your full retirement age, your benefit increases by 0.2%. Every year of delay adds 8%. For someone with a full retirement age benefit of $2,500 per month, claiming at full retirement age versus age 70 produces the following. At full retirement age, $2,500. At 70, roughly $3,250 for someone born in 1959 with a full retirement age of 66 and 10 months, adding approximately 26.7%. The monthly difference is $750, $9,000 per year permanently. The break-even point for this claiming decision, the age at which total lifetime income under the two strategies is equal, is approximately age 80 to 82, depending on the exact full retirement age. The average 64-year-old American woman has a life expectancy of approximately 87 years. The average 64-year-old man has a life expectancy of approximately 84 years. Both of those figures are past the break-even point, meaning for most healthy people in this birth cohort, the actuarial case for delaying is strong. There is also a specific tax angle I want to address as an enrolled agent, because this is where my background adds a dimension that pure Social Security discussions often miss. The taxation of Social Security benefits depends on your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security benefit. If your combined income exceeds $25,000 as a single filer or $32,000 as a married couple, a portion of your Social Security benefit becomes taxable. The interaction between claiming age and tax liability is significant. A lower monthly benefit from claiming at 62 may result in less of that benefit being taxable in any given year, because the lower amount keeps combined income below the taxation thresholds. A higher benefit from claiming at 70 may push more of the benefit into the taxable range. However, this interaction is almost never a reason to claim earlier than optimal. The after-tax benefit at 70, even accounting for the higher taxable portion, almost always exceeds the after-tax benefit at 62, because the gross benefit difference is so large. Running the after-tax calculation for your specific income situation is important, but the conclusion for most people is that the tax impact does not change the optimal claiming age. What the tax angle does affect is the Roth conversion strategy during the bridge years between retirement and claiming at 70. If you retire at 63 or 64 and delay claiming Social Security until 70, you have a window of several years with relatively low taxable income. This is the optimal window to convert traditional IRA or 401k money to Roth at lower tax rates. Conversions during this window reduce future required minimum distributions, reduce future taxable income when Social Security begins, and may keep more of your eventual Social Security benefit below the taxation thresholds permanently. I have helped clients reduce their lifetime federal income tax by $40,000 to $60,000 through strategic Roth conversions coordinated with delayed Social Security claiming. The two strategies reinforce each other. Each makes the other more valuable. The fourth major issue is household coordination, and why it is specifically critical for people born before 1961. When one spouse dies, the surviving spouse receives the higher of the two monthly benefits. The amount the higher earner locked in at their claiming age is the amount the surviving spouse will receive for potentially decades of widowhood. For a couple where the higher earner was born before 1961, has a full retirement age between 66 and 2 months and 66 and 10 months, and delays claiming from that full retirement age to 70, the delayed credits add between 26.7% and 30.7% to the base benefit. The lower earner claims at their own full retirement age to provide household income during the gap years. The higher earner claims at 70, and that higher amount is locked in for the survivor. The specific dollar impact of this coordination is substantial. A couple where the higher earner has a full retirement age benefit of $2,800 per month receives a survivor benefit of approximately $3,472 per month if the higher earner delays to 70, versus $2,800 if the higher earner claims at full retirement age. The survivor benefit difference is $672 per month, $8,064 per year. Over 15 years of widowhood, that is $120,960. That one number, the survivor benefit difference under two different claiming strategies, is often the most compelling figure in the entire Social Security conversation. It converts an abstract decision about optimal claiming into a concrete protection for the person you love most. The fifth major issue is the 12-month withdrawal option for people born before 1961 who claimed recently and are having second thoughts. If you claimed Social Security retirement benefits less than 12 months ago, and you are now questioning whether that was the right decision, you have the right to withdraw your application, repay every dollar you received, and restart as if you never filed. The clock resets. You can then delay to your full retirement age or beyond and receive the higher benefit. The withdrawal must be filed using Form SSA.gov within 12 months of your initial benefit start date. The repayment includes all benefits you received, plus any Medicare premiums deducted from your checks. Once repaid, your record is clean, and you can file a new claim at any later age. The calculation for whether withdrawal is worthwhile is the same as for the original delayed claiming decision. You repay an amount, you forego income during the delay period, and in exchange you receive a permanently higher monthly benefit. If you expect to live significantly past the break-even age, the withdrawal and restart produces more lifetime income. For someone born before 1961 who claimed in the past 12 months and has a full retirement age benefit that could be meaningfully increased by delaying to 70, the window to reverse that decision is still open. It is worth modeling the numbers before the 12-month mark passes. Let me close with the actions that matter most. Log into SSA.gov and review your earnings record for 0 years. If you are still working and have gaps, model the benefit impact of working additional years. If you worked in a public sector job with a pension and have never claimed a spousal or survivor benefit, call 1-800-772-1213 this week. If you have not yet claimed and are approaching or past your full retirement age, calculate the benefit at 70 and model the tax impact of Roth conversions during the gap years. If you have a spouse, run the survivor benefit comparison under different claiming scenarios. The difference is often the most financially consequential number in the analysis. And if you claimed within the past 12 months and are questioning the decision, model the withdrawal and restart calculation before the 12-month window closes. Send this video to one person in your life who was born before 1961 and who has not yet had a complete conversation about their Social Security options. The window to optimize this decision is open right now. I will see you in the next one. Let me go deeper on each of the 5 issues because the practical details are where the money actually lives. On the Social Security Fairness Act, I want to address the IRS dimension that most coverage of this law has missed entirely. When the windfall elimination provision reduced your Social Security benefit, that reduced benefit was what was reported on your SSA 1099 each year, and what you used to calculate whether any portion was taxable. Now that the WEP has been eliminated and your benefit has increased, the higher benefit may change your combined income calculation and potentially push more of your Social Security into the taxable range. Specifically, if your retroactive lump sum payment from the Fairness Act arrived in a single tax year, that lump sum is taxable income in the year it was received. If the lump sum was large, it may have pushed your income significantly above the Social Security taxation thresholds in that year, resulting in an unexpectedly high tax bill. There's a provision in the tax code that provides relief for lump sum Social Security payments. Under Section 86E of the Internal Revenue Code, you can elect to calculate the tax on a lump sum Social Security payment as if it had been received in the years to which it relates, rather than all in the year of receipt. This calculation is done on a worksheet in the Social Security lump sum election section of your tax software, or on a manual worksheet from the IRS. For someone who received a retroactive Fairness Act payment and did not apply this election, the result may have been that they paid more tax on the lump sum than necessary. An amended return for the tax year in which the lump sum was received may recover a portion of that overpayment. If you received a retroactive Social Security payment in 2024 or 2025 as a result of the Fairness Act, and you or your tax preparer did not specifically review the lump sum election option, this is worth examining. An enrolled agent or tax professional can run the calculation to determine whether the election would have reduced your tax liability and whether an amended return is warranted. On the 0-year problem, I want to address a specific group of people born before 1961 whose situation is different from the general case. Some people in this birth cohort spent significant portions of their careers as self-employed contractors, consultants, or small business owners. In years when business income was low, or when self-employment taxes were paid on a reduced amount, the Social Security earnings credited to their record may be significantly lower than their actual economic activity during those years. Self-employment income is reported on Schedule SE, and the earnings credited to your Social Security record are based on your net self-employment income after deductions. In years when business deductions were high, the net earnings subject to self-employment tax, and therefore the earnings credited to Social Security, may have been modest even if gross revenue was substantial. For someone with a history of self-employment, reviewing the earnings record carefully against their actual net self-employment income from prior tax returns can identify whether the record accurately reflects what was subject to Social Security tax. If there are discrepancies, they can be corrected with documentation from the relevant tax returns. Additionally, for self-employed people who are still working and approaching the decision about when to claim, the marginal value of additional years of self-employment earnings in the Social Security calculation is worth modeling explicitly. A year with strong net self-employment earnings that replaces a low or 0 year in the 35-year calculation produces a permanent benefit increase. The comparison between the additional taxes paid and the additional lifetime benefit received is a specific calculation worth running. On the delayed claiming and Roth conversion strategy, I want to give a concrete example of how these two decisions interact. Take a couple where the higher earner is 64 years old, born in 1961, with a full retirement age benefit of $3,000 per month. They retire now and plan to claim Social Security at 70. They have a traditional IRA of $600,000. Their combined income from part-time work and investment income during the gap years is approximately $30,000, putting them in the 12% federal income tax bracket. During the 6 years between retirement and claiming Social Security, they can convert $60,000 per year from the traditional IRA to Roth while staying within the 12% bracket. Total conversions of $360,000 over 6 years, paying approximately 12% on the converted amount, is approximately $43,200 in total conversion taxes. At age 70, Social Security begins at approximately $3,744 per month, reflecting the 24.8% increase from delaying from 66 to 70. The combined income now includes Social Security, required minimum distributions on the remaining traditional IRA balance of approximately $240,000, and any other income. Compare this to not converting. The full $600,000 IRA at 70, with required minimum distributions beginning at 73, produces first-year RMDs of approximately $22,642. Added to Social Security and other income, this may push a significant portion of Social Security into the taxable range and keep the household in the 22% bracket for many years. The coordinated strategy, paying 12% on conversions now versus 22% or more on RMDs later, saves tens of thousands of dollars in lifetime taxes. The Roth conversions also reduce future required minimum distributions, reducing the tax cost of the Social Security benefit itself. On the household coordination strategy, I want to address the specific situation of couples where the lower earner is significantly younger. In marriages with a significant age gap, the household coordination strategy is even more important because the survivor benefit may be in payment for a very long time. If the higher earner is 64 and the lower earner is 58, and the higher earner delays claiming to 70, the survivor benefit that the lower earner eventually receives could be in payment for 20 to 30 years or more. The dollar impact of the higher earner's claiming decision, compounded over a 30-year survivor benefit period, can be extraordinary. An additional $600 per month in survivor benefit over 30 years is $216,000. That figure does not include cost of living adjustments, which will increase the nominal amount further each year. For couples with an age gap, the claiming strategy analysis should explicitly model the survivor benefit duration based on realistic life expectancy for the younger spouse, not just for the higher earner. The relevant comparison is not break-even for the higher earner. It is total household lifetime benefit under different strategies. On the 12-month withdrawal option, I want to address the funding question specifically. The most common reason people who want to withdraw their application do not follow through is that they do not have the cash readily available to repay the benefits already received. Repayment is a condition of the withdrawal. The SSA does not approve the withdrawal and then wait for you to gather the funds over time. The repayment must accompany or quickly follow the withdrawal application. However, there are funding sources that can provide the repayment amount. An IRA withdrawal, even if taxable, may be worth the tax cost if the delayed benefit increase produces more after-tax lifetime income than the alternative. A home equity line of credit or a short-term personal loan can provide the repayment funds. And in some cases, the monthly benefit itself during the period since claiming may be sufficient to cover the repayment, particularly if a short time has elapsed. The calculation is this. Compare the total cost of the repayment and any funding costs against the present value of the additional lifetime benefit from delaying. If the present value of the additional benefit significantly exceeds the repayment cost, the withdrawal is financially rational. For a 64-year-old who claimed 8 months ago and has received approximately $20,000 in benefits, repaying $20,000 and then claiming at $70,000 instead of now adds several $100s per month permanently. The $20,000 repayment is recovered in approximately 5 to 7 years of higher monthly payments. Over a 20-year remaining life expectancy, the total additional benefit is several times the repayment cost. The window is 12 months from your initial benefit start date. If you are approaching that deadline and have been considering a withdrawal, run the numbers and act before the window closes. I will see you in the next one.